Welcome to Iron Financial. Our mission here is simple. We're here to help you forge a stronger portfolio and to cut right through all the weakness and the noise in the market. Today, we are putting Clorox, CLX, directly under the microscope. This is a name everyone knows, a brand in every household. But they just dropped their latest earnings, and we have got to figure out if this company's foundation is still made of solid rock or if we're starting to see some very, very serious cracks begin to show. Okay, let's get into it.
Right, so think about Clorox. For literally decades, this stock has been the absolute definition of stable, of defensive. You know, it's the kind of company you buy for your grandma's portfolio and you just don't worry about it. But right now, today, the market is sending a totally different signal. Their latest earnings report, this is for Q2 of their fiscal year, it just hit the street, and Wall Street is, well, they're not happy. The initial reaction has been fast, and it has been painful. So the question we have to answer right now is simple. Why? What is buried in these numbers that has so completely spooked investors and sent them scrambling for the exits? And here it is. Here is the market's gut reaction in one number, a drop of over 4%. Now, for a slow and steady giant like Clorox, that is not a little dip. That's a shockwave rolling through the stock. It is an unmistakable signal that the big money, we're talking the institutional funds, they are smashing the sell button and they are not looking back. That right there is a huge red flag, and it's one we are absolutely compelled to dig into.
Yeah, let's really put that percentage into hard dollars, because 4% can kind of sound abstract. What this actually means is that in the snap of a finger, the market decided that Clorox was worth over $600 million less than it was just a moment before. $607 million of value just, poof, gone. That's not just some little red flag anymore, that is a 5-alarm fire bell clanging. It tells me the market saw something in this report that it believes is a fundamental structural weakness, a crack in the company's very foundation.
Exactly. So that's our job today. We are going to conduct a full structural analysis, top to bottom. We're going to kick things off by assessing the raw damage from this Q2 report. Then we'll drill down deep into the individual business segments, see which pillars are actually holding the weight and which ones are starting to buckle. After that, we are going to scrutinize management's big explanation for all this thing they're calling an ERP inventory issue. Then we're going to turn to their massive bet on the future, the huge acquisition of GOJO. And finally, we will deliver our verdict. Is this fortress truly built to last, or is it just a pretty facade that's about to crumble?
All right, let's get our hands dirty with the raw data. Section 1, the Q2 damage report. This is where we look at the big, ugly headline numbers, the exact figures that triggered that initial sell-off. We need to measure the precise dimensions of these cracks before we can even begin to figure out how deep they really go.
Okay, let's start at the very top of the P&L, net sales. Down 1% to $1.67 billion. Now look, in a normal world, that's just stagnation, right? It's flat. But in the inflationary environment we're in today, where the cost of literally everything is climbing, flat is the new down. A 1% drop is actually a really serious problem. It tells you they either can't raise their prices enough to keep up, or they're not selling enough volume to offset it. Either way, that's a fundamental sign of weakness right at the start of the income statement. But the real pain, the really sharp pain, starts as you move further down that income statement. Diluted earnings per share. This is a critical metric for profitability. It plummeted 16%. 16% down to $1.29. A 16% drop in earnings for a company like this is severe. This is way more than just a minor stumble. It tells us not only are they selling less stuff, but they are making significantly less profit on every single thing they do sell. The pressure on their margins, on their profitability, it is absolutely immense. And this is the number that almost certainly caused that $600 million panic attack on Wall Street. Adjusted EBIT, so that's their earnings before interest and taxes, for their core household segment just collapsed. It fell by 54%. Let me say that again so it sinks in. A 54% collapse in profitability in one of their main bread and butter divisions. This is not a crack, people. This is a gaping sinkhole opening up in the foundation. This is the segment with brands like Glad Bags, Fresh Step cat litter, the absolute staples of their business. For earnings to get sliced in half here, it's nothing short of a catastrophe.
Okay, hold on. So you've got sales down, earnings per share getting hammered by 16%, and the profitability of a core division just imploding by more than half. Now, with all that as the backdrop, listen to the official statement from the chair and CEO, Linda Rendle. She says, and I'm quoting here, "Our second quarter results were generally in line with our expectations." In line with their expectations?
You're telling me they were expecting earnings in a key segment to just collapse by 54%? Come on. This is the exact kind of corporate jargon that drives me and every other investor absolutely crazy. It feels completely and utterly disconnected from the financial reality we just laid out. It really begs the question, is management being straight with us, or are they just trying to paper over these gigantic cracks with some reassuring, calm language? Because when the numbers are this bad, telling everyone that it's all part of the plan, that is a very, very tough pill for the market to swallow. It makes you wonder what else is going on behind the curtain.
That is a completely fair challenge. And to answer it, we have to peel back another layer. We have to go deeper than just the headline numbers. So let's move on to our next section where we're going to analyze the business segments themselves. You see, a company like Clorox, it's a big, complex building. It's held up by multiple pillars. We need to go and stress test each and every one to see which ones are actually bearing the load and which ones are about to give way. Now, what's so fascinating about this slide is the story it tells. And it is not a story of a company in uniform decay. No, it's a tale of two extremes. Just look at the household segment. We're talking bags and wraps, cat litter, grilling products. Sales are down 6%. And there's that catastrophic 54% cratering in earnings we keep talking about. This pillar is actively crumbling. Then you have the lifestyle segment. That's their food, water filtration, personal care stuff. It's also weak on sales, down 5%. Though somehow they managed to squeeze out a tiny little profit gain. But then you look at the bottom line. International, sales up a very healthy 7%, and adjusted EBIT up an incredible 48%. This is the one pillar that isn't just holding up, it is thriving. It's a monster outperformer. And meanwhile, health and wellness, which is their biggest segment by sales, is just flat, treading water. Sales up 2%, profit down 2%. So the picture is incredibly complex. One part of the business is in an absolute free fall, another is rocketing to the moon, and the biggest piece of the pie is just stuck in neutral. All right, so we firmly established that the core U.S. business, and specifically that household division, is in some serious, serious trouble. Now let's get to the company's official reason, their explanation for all this chaos. Management is pointing the finger at something they're calling an ERP inventory drawdown. Now, I'm calling this section the excuse, because anytime a company blames a single, one-off operational hiccup for this much financial damage, you have to be deeply skeptical. So is this really just a one-time problem that they've already got their arms around? Or is it a symptom of a much deeper, more permanent flaw in how they run their business? So let's just define this term so we're all on the same page. ERP stands for Enterprise Resource Planning. Think of it as the massive, sprawling digital nervous system that runs a company's core operations. We're talking finance, supply chain, manufacturing, all of it. Clorox just finished a huge, multi-year, very expensive upgrade of this entire system. Now, in anticipation of things going wrong during the switch, which they often do, they encouraged all their retail partners, your Walmarts, your Targets, your Costcos, to order a bunch of extra product beforehand, just to make sure the shelves stayed full no matter what. Well, an ERP inventory drawdown is the massive hangover from that party. The retailers are now sitting on warehouses packed to the gills with Clorox products, so they just stop placing new orders until they can sell through all that excess stock. So the key thing to get your head around is this simple three-step process. First, at the end of their last fiscal year, Clorox shipped a ridiculous amount of product. They essentially pulled future sales into the past. Step 2, the new year kicks off and all their retail partners are sitting on a mountain of inventory they just bought. And that leads directly to step 3. The retailers slam on the brakes. They hit pause on new orders. So for Clorox, this creates what you could call an air pocket in their sales. Even if you and I are still buying Glad bags off the shelf at the same rate, Clorox's own reported sales, which are based on their shipments to the retailers, not the final sale to us, fall off a cliff. This is the exact dynamic they claim is responsible for these ugly, ugly numbers. And they haven't been shy about putting a number on the impact. According to their own guidance, this inventory issue is responsible for a massive 7.5 percentage point drag on their full-year organic sales growth. Now, to put that into perspective, they are guiding for total organic sales for the whole year to be down somewhere between 5 and 9%. So do the math. Without this one single issue, their sales would be somewhere between up 2.5% and down 1.5%. That is literally the difference between a growth story and a story of pretty significant decline. And it gets even more dramatic when you look at the bottom line, at the profits. They are explicitly telling us that this one issue is slashing a full 90 cents from their full-year earnings per share. Now, their guidance for the whole year is for EPS between $5.60 and $5.95. So you're talking about a 15% hit to their entire year's profit, all from this one supposedly transitory issue.
So the bull case here is that this is just a temporary self-inflicted wound that's going to heal soon. But the bear case, and this is my big concern, is that this much disruption just screams poor execution. I mean, did they really have to pull forward that much inventory? And are they absolutely certain this is the only problem? Or is this whole ERP mess just providing convenient cover for other weaknesses? Like maybe, just maybe, falling consumer demand? That is the billion-dollar question right there. And while they are wrestling with all these internal operational fires, they're also making a gigantic, company-altering bet on the future. So let's pivot now from the problems to their proposed solution, their blueprint for a total rebuild. Clorox is in the middle of making a massive acquisition. They've announced a definitive agreement to buy GOJO Industries, and if you don't know that name, you definitely know their main product, Purell. The price tag, $2.25 billion, all cash. This is a monster deal. The brand Purell is basically the Kleenex or the Xerox of hand sanitizer. With this one move, Clorox is doubling, maybe even tripling down on the entire health and hygiene space. This is not some small tuck-in acquisition. This is a transaction that will redefine what Clorox is as a company for years to come.
And the strategic thinking here, at least when you see it on paper, is crystal clear. First, it just massively expands their footprint in the whole hygiene category. Second, they're betting that there are long-term tailwinds for hygiene, in a post-pandemic world. Third, Clorox thinks its incredible expertise in retail, its deep relationships with Walmart, Kroger, all the big dogs, can explode Purell's growth on consumer shelves. And fourth, it works in reverse for the professional business. It gives them instant access to GOJO's massive B2B network of distributors and, get this, their installed base of 20 million dispensers in offices, hospitals, schools, you name it.
And this slide illustrates the argument perfectly. Clorox is an absolute master of the consumer retail game. GOJO is the undisputed king of the business-to-business, the B2B, hygiene market. GOJO has the dispensers, the stable, recurring revenue, and that deep distributor network that Clorox could only dream of. Clorox has the brand-building muscle and the retail power to take Purell to a whole new level in stores. On the surface, it looks like a perfect puzzle piece fit. But here's the skeptical take. Is this a brilliant strategic move, or is Clorox, looking at that minus 54% collapse in its household segment, simply being forced to go out and buy growth because its own foundation is starting to rot from the inside? Are they overpaying for a shiny new toy to distract everyone from the serious problems in their own house? Remember, they're funding this almost entirely with debt, which adds a huge amount of risk to their balance sheet at the exact moment their core operations are already under a ton of stress.
That's an excellent point. The execution risk here is now off the charts, both in cleaning up this ERP mess and in trying to integrate a $2 billion company at the same time. And that brings us to our final section, the verdict. We've examined the cracks, we've stress-tested all the pillars, and we've reviewed the blueprints for the rebuild. So the big question remains, is this structure fundamentally sound? Is it truly built to last? The bull case. The argument that this is a fortress under construction, it's a compelling one. It says, look, the ERP issue, yeah, it was painful, but it's temporary. They've put a number on it, a 90-cent impact, and once that's in the rearview mirror, the company's true earnings power is going to shine through. The bulls point to the incredible strength of the international segment, growing profits by 48%, as definitive proof that the company can still execute at a world-class level. They argue the GOJO deal is a strategically brilliant chess move to accelerate growth in a key category, and through it all, their operating cash flow remains solid as a rock. But the bear case, the argument that this is a facade beginning to crack, is every bit as powerful. It zooms in on that 54% profit collapse in the core household segment. That is not a blip, it's a 5-alarm fire. The bears point to the CEO's statement saying things are in line with expectations as a giant red flag that management is either disconnected from reality, or worse, they're not being completely honest. The execution risk right now is absolutely massive. They have to fix the ERP disaster and integrate a huge complex acquisition simultaneously, and they're doing all of this after taking on billions of dollars in new debt right when their core business is showing signs of profound weakness. It is a very high-wire act with almost no safety net.
So that right there is the fundamental question that you, as an investor, have to answer for yourself. Is what we are watching here a structurally sound company that's just going through a very messy but ultimately necessary renovation? Are they tearing out old, weak walls and putting up new, stronger ones with the GOJO acquisition, setting themselves up for a decade of future growth? Or are all these complicated explanations and big strategic moves just cosmetic repairs? Is it just a fresh coat of paint to hide the fact that the building's very foundation is fundamentally failing? The evidence we've laid out for you today gives you the framework and the tools to make that call for your own portfolio.